Okay, it's that time. Welcome to the Fats, Fuels, and Oils webinar for March 8th. This week, we're going to talk a little bit about the fats and greases market. Um, Prices have continued to remain well supported, in part because of the sharp rise in energy prices that we saw last week. Energy prices were up 25%. In part because of the relatively bullish fundamentals for vegetable oils and feedstocks. And then, of course, the anticipated expansion of renewable diesel capacity and the implications that it has for feedstock demand. And all of that has pushed distillers corn oil prices up to a further record, and most of the fats and greases prices are at record levels. The big question is kind of what happens now. Do we continue to move up to higher and higher record levels, or have we seen the peak? And there has been some news on the Ukrainian situation. Apparently, it seems like, at least based on what the stock market and to a lesser extent the oil market is doing, there looks to be some movement, at least a little bit, towards some resolution, a peaceful resolution to that situation, with the Ukrainian president acknowledging that he's open to a solution that doesn't involve Ukraine seeking NATO membership and possibly recognizing the states in eastern Ukraine that Russia claims should be independent states. Whether that all gets resolved or not, I think will have a substantial impact on the markets, obviously, particularly the energy market. But remember that energy prices were rising before the conflict, a little bit in anticipation of the conflict, but probably more importantly because the world was short crude oil prices. So even if there is a resolution to the Ukrainian conflict, I think that obviously there would be significant headline risk. Prices would probably fall sharply, but then stabilize and probably start to move back up, although much more slowly than they did last week. With regards to DCO and fats and greases specifically, and I suppose feedstock prices more generally, we have heard anecdotal reports that the Biden administration is considering a reduction in the RFS mandates to reduce the cost of compliance. Of course, this is what they did in December when they released the preliminary mandates. They cut the mandates for 2020 and 2021 basically to match them up with production, and the cuts were really focused on ethanol. And so this has a particular impact on DCO. And while I think it's pretty easy to say that if the final mandates, the mandates that were released in December were the preliminary mandates, if the final mandates are lower than the preliminary mandates, it's likely that the cuts will be focused on ethanol production or on the ethanol mandate. And this would have a kind of a little bit more complex impact on DCO than it would on some of the other feedstocks. Now, if we assume that the mandates would be cut, if the cuts would be focused on the ethanol mandate, then what that really implies is not necessarily a cut in ethanol production, because as we have talked about before, there's a gap between what we expect ethanol production to be and the mandate of about 400 million gallons. So it's not clear that a cut in the mandates would result in a reduction in ethanol production and by extension a cut in DCO supplies. So you would have a situation where you could have a cut in the mandates, but ethanol production basically remains the same, but you have a reduction in biomass-based diesel production because you don't need this additional 400 million gallons of biomass-based diesel to meet the overall mandate. Um, so you would have unchanged DCO supplies and lower DCO demand, although still the world vegetable oil fundamentals remain bullish. So that might limit the impact of any cut in the mandates on prices. But still, it might be that that DCO drops a little bit more sharply than some of the other feedstocks. But I think you could also make the argument that potentially, if you get a cut in the ethanol mandates, that the impact on DCO might be a little bit less than on other feedstocks. And that argument would go something like this, where they cut the ethanol mandate and cut it enough so that ethanol production actually is impacted, or ethanol production is just impacted by the fact that any cuts in the mandates is going to have an impact on RIN prices. And so ethanol profitability goes down a bit, and you have a reduction in DCO supplies, again against a backdrop that is relatively bullish. And so given a cut in the DCO supply, you might have a lesser impact on DCO prices than you would on the other feedstocks. Now, it's really hard, I think, to handicap exactly how this will all shake out, because one, we don't even know if they're going to make any cuts. So far, it's only been rumored. I think there are some reasons that you could argue that this isn't a good time to make cuts, because if the world is short of energy, policies that reduce energy production in any form probably won't do much to alleviate the inflation that's coming from energy prices. Two, I think that that the Biden administration is certainly more supportive of environmental goals and decarbonization than I think you could say the prior administration was. And so cutting the mandates might not be a good look, although even that's a little bit complicated, because I think really the way that they view decarbonization is with the idea that we'll move to electrical vehicles more quickly than renewable fuels made out of plants. Now, there's a whole other argument that you can get into about jet fuel and the market size of diesel and how quickly we can actually get to electric vehicles. But the point there really is just that if electrical vehicles are really their goal, they may not see a cut in the renewable mandates as much as a negative for the environmental lobby, I suppose, as some others might see it. And so there may be less of a political penalty for them to do that than you might otherwise think. All of that said, like I said, they did reduce the mandates for 2020 and 2021. Again, I think that was in part that was just a practical solution to the fact that we hadn't had mandates in a couple of years, and so setting the mandates at the levels of production was something that was an easy way to kind of move forward. I don't say whether that's right or wrong. I just say that from a very practical perspective, setting the mandates where production was, it was a solution that made it relatively clean to kind of move forward. So whether they make the cut or not, we'll have to see. I think in large part that will depend on what happens in Ukraine and with energy prices. Like I said, I'm not an energy analyst, but certainly I can see that energy prices were rising before Russia invaded Ukraine, and it seems likely to me that after an initial decline, that energy prices would continue to rise. Whether they get back up to the current levels or not, I don't know enough about it to say that, but I do think that it's fair to say that the trend was higher before the invasion, and that would likely continue. Outside of that, what we have seen, let me go to the here. What we have seen, like I said, are record prices, and we've also seen the forward offers for May and June are at or above current levels for most of the fats and greases. So it doesn't seem like in the short term we're going to see prices come down again, unless there's some big headline risk or some announcement about the RFS mandates. That said, at least right now, we don't expect prices to rise a lot further. You can see from our DCO forecast, we kind of have prices rising steadily through the end of the year and into 2023. The prices for fats and greases are generally related to soybean oil. Those relationships have gotten they've changed pretty dramatically over the last year or 18 months, I suppose, where the historical norms that you used to use to forecast DCO prices relative to soybean oil prices, or DCO prices as a percentage of soybean oil prices, those relationships have certainly changed. And so our soybean oil forecast obviously starts to move down in the summer, because we expect sort of normal growing weather. At this point, we expect normal growing weather. You don't necessarily see that with our DCO price forecast, in part because of that change in those relationships. That said, I think if soybean oil prices start to move down substantially during the summer, which I don't really expect, but if they did, I think our DCO price forecast would probably look a little bit different, and we probably would suggest that prices peak out maybe at these levels, or maybe a little bit above these levels, and then start to move lower into the fall. But if we assume that soybean oil prices remain close to the current range, then this is sort of what or continue to move higher. This is kind of what our forecast looks like. All right, with that, let's move on to biomass-based diesel and our margin forecast. Margins were, as you can see from the chart, jumped quite a bit this past week. That's in part because of the 25% increase in energy prices. There was a relatively larger increase in renewable diesel prices. Renewable diesel prices rose about 18%, while biodiesel prices, including the credits, so the way biodiesel is priced in the markets that we quote is including the credits, that only rose by 2%. In part because of the stories about the potential cut to the RFS mandates. And so I think probably the fuel price rose in line with renewable diesel in the broader energy market. But we saw a tick down in RIN prices, and I think that probably offset some of the gains in the pure energy prices. And so that's why from just a biodiesel price standpoint, the increase wasn't as great. So we've got big jumps in profitability for both, and that has changed our outlook for at least the next several months, where the higher energy prices, at least in the short term, have lifted our forecast for profitability pretty sharply. What they haven't changed really is our expected trend in profitability, and that is that that profitability will remain under pressure into the summer as rising feedstock prices offset the recent gains in energy prices, and we expect feedstock prices will offset potential future gains in energy prices, although that's a very tough call. The way that we do our energy price forecasts is that we don't try and spend a lot of time predicting the future for energy prices, because again, that's not really my area I'm not a specialist in that area. And so we tend to take the current price, and then we tend to build in something going forward that looks more like an average of prices, or an average of price expectations. And so our price forecasts going forward tend to be lower. I say all that to say that, again, if something happens and the Ukraine situation gets sorted out peacefully in the relative short term, I think that, again, energy prices would drop pretty sharply, but probably drop down to the levels that we saw before the invasion, sort of stabilize and move higher. That would impact our price forecast really only in the short term. It would move the price forecasts over the next several months, or the profitability forecasts over the next several months, down quite a bit. But as you go further out, our energy price forecasts are really sort of at the levels or around the levels that we saw before the invasion. And I don't think that there would be as much of an impact further out in the curve as there would be in the short term. So I think, given the volatility that we're seeing in the markets right now, it's probably more important to pay attention to the trends in the forecast and the risk to the forecast than there is to the specific forecast itself. So instead of saying that the profitability with credits for renewable diesel is going to be $2.50 a gallon, I think it's probably more important to focus on the trend, which we think is profitability probably remains under pressure. That and then also you want to talk or think about the risks to the forecast. And obviously on the energy side, the biggest risk to the forecast is the Ukrainian conflict and in any potential resolution of that. On the feedstock side, the biggest risk to the forecast, or the biggest risk to our outlook right now, is the North American growing season, which is going to hit us pretty quickly. Farmers will start to plant over the next several weeks, and they'll finish up planting sometime in late May or early June, depending on weather conditions over the next several months. I've talked about this before. Again, the oilseed market has the world fundamentals are relatively bullish. Even if you add Ukrainian sunflower and sunflower oil production back into your world supply assumptions, the market still is relatively bullish. Whether adding Ukraine in justifies soybean oil futures at 76 cents or 74 or 73 cents, something like that, I don't think that will make much of a difference. Again, probably some headline risk, but probably not a big risk to the outlook in the long term. If we don't have a growing season that supports trendline yields in the US, then, as I've talked about, I think that prices could move sharply higher, even if we do have a resolution of the Ukrainian conflict, just because of the shortage in canola oil that we already are experiencing due to last year's drought and the drought in South America that has reduced production in Brazil and Paraguay and Argentina pretty substantially from where people thought much earlier in the year. And against all of that backdrop and the moves that we've seen in across commodities markets, really, it's not even just the agricultural markets where wheat has moved limit up or limit down on multiple days, but you saw this morning the LME suspended nickel trading because nickel prices essentially doubled overnight due to basically a big short squeeze for producers that have short hedges. Given all of that, again, the volatility in these markets means that it's probably more important to pay attention to the trends in the forecast and the risk to the forecast rather than the outright numbers themselves. All right, on to our RIN forecast. So our RIN forecast looks a little bit different this week, still generally higher. We widened out the spread between D4 and D6 in part due to the movements in RIN prices recently, and in part due to this potential for a cut in the RFS mandates. We still have the spread between the two narrowing as we go forward from its current. I think it's about $25 or so right now. I think we have it narrowing down to like $15 or something over the coming year, or at least through the end of 2022. The risk there is that I think if you don't get a cut to the mandates, I think that spread can be narrower, and we may spend the summer sort of tightening up the spread between D4 and D6. If we do get a cut to the mandate, and again, if we get a cut that is sufficient to offset the 400 million gallons of biomass-based diesel production that would be needed to meet the overall mandate based on our expectation for ethanol production and consumption. If that gets eliminated, then I think the spread probably starts to widen out and is probably a little bit wider than our forecast. So we've tried to get kind of a balance between those two scenarios, and that's kind of where we landed. Either way, at least right now, it looks like RIN prices will move higher based on our expectation for higher feedstock prices. If our expectation for feedstock prices were to change substantially, then I think our RIN price forecast would probably follow our feedstock price forecast as well. So two risks to the higher outlook here: one, change in the mandates, and two, if we start to lower our feedstock forecast, the RIN price forecast probably will follow. And on to the LCFS credit price. This forecast, we actually lowered a little bit LCFS credit prices after stabilizing around 150 for a couple of months. Actually, several months have started to move lower again. And so we cut our forecast down, and now we have a forecast that actually goes down to 115, which is kind of where we think the bottom is. Again, that's not a high confidence forecast. I wouldn't bet a lot of money on 115 one way or the other. But that's kind of just based on history and on what some statistical models tell us, to be quite frank about it. That's kind of where we think it is. And so again, I think the important part to remember here is probably the trend. I did our long-term outlook, and I think I talked about this last week. We think the trend is lower in the short term, but we think in 2023 the deficits start to catch up with increases in production, and LCFS credit prices start to rise again. But I think you've got to go through the rest of 2022 and probably into 2023 before you'll start to see an increase in LCFS credit prices. At least that's assuming that all of the renewable diesel capacity comes online and production continues to rise and all of that stuff. If something were to change dramatically with regards to the outlook for renewable diesel capacity, our outlook for LCFS credit prices would change substantially. Or if we saw that biodiesel production was falling much more quickly than we're anticipating, that would also have an impact. All right. With that, I will open it up if anybody has any questions. If not, we will actually get out of here a little early today, which is unusual. All right, if there's no questions, thanks everybody for attending, and we will see you next week when we talk about vegetable oils. Everybody have a great weekend.